given that the Fed has done exactly what we thought it would do, continue to reduce its printing of money by $10 billion a month, what do you think of the market reaction?
Well, I don't think the market is reacting to the Fed. This was obviously kicked off ahead of the Fed's decision. They did exactly what everybody was expecting. Anything different actually should have sparked a reaction. So really, this is about nervousness, I think, going into the earnings season. We knew Q4 was going to be a challenge, and I think that really we have to wait until the Q4 earnings season dust settles.
Not reacting to the Fed here, Nathan, what's your take?
My take is that there's three great lies, Kelly. The check's in the mail, I'll call you, and tapering was priced into this market. There was no way tapering was priced in. I don't think we don't know how to analyze a statistic going. We don't know what to do with inventories when people are freezing and they can't go out. Truck sales are roaring, and yet nobody wants to put a dishwasher on the back of their truck when it's minus 20 below. So I just think we're going to go through the great repricing and the great reassessment, and that's happening right now.
Where does that repricing take us to?
Well, it's going to take us to where real revenue is and where real earnings are once we get rid of the Fed taper. And I think the big surprise today was that Bernanke said he's going to keep unemployment at 6.5%. Good luck. I think as soon as Yellen gets in there, she says, night-night to that, we're going to 6%, and then everybody will relax.
But if that's the case, Steve, then why are markets so jittery here? Is it, as Nina suggested, perhaps we're placing too much emphasis on the Fed? Because it seems like whether it's today's decision or just generally the stance of monetary policy this year, it's going to be a problem for some of these emerging markets.
You know, I always thought one of the more curious things was the market rally on the day the Fed tapered back in December 18th. I would think that the market declining makes more sense in light of the tapering. And the question I'm asking myself now is there a tolerance at the Federal Reserve for some decline in stocks, at which point it becomes a troubling macroeconomic event or something that changes the forecast? I don't think we're there yet. I think the Fed got half of what it wanted, which is stable interest rates. Last I checked, the 10-year was trading around 270, and I think they're going to be relatively pleased with that and think that that gives a green light to their policy. But I think when they see the market declining the way it's been, it's right back a bit below where it was when it tapered back in December 18th. I think it's going to keep a watchful eye on stocks because that's a measure of financial conditions for the Federal Reserve.
At the same time,
Steve, that's a wealth effect. That's a wealth effect you got going on there, Steve. What happens when Yellen gets in and she wants to create jobs and she doesn't care about the wealth effect?
I mean, I think there's still a wealth effect out there. I don't think we've seen a tremendous wealth effect in the economic numbers so far. So the idea that the wealth effect from the stock market has been something that's been pumping up the economy, at least it hasn't shown up very well in the data so far.
It is a little bit ironic, Rick Santelli, that today is the day that Treasury launches its first new product since 1997, a floating rate note. In fact, we've had quite a rally. Rates have dropped so far year to date. Yet that auction went off well. I guess people are buying anything that has the word Treasury on it.
Well, especially when it's the first auction. You know, a lot of these dealer types and large clients need to, they need to know what the product's about. They need to own it. It's like when they brought the 7-year back. But let's look at what's really going on today. If you look at a chart of the Dow and the 10-year note yields, pretty much enough said. But once again, the treasuries are a natural hedge against what's going on in equities. If you look at the fact that we haven't been down here since about mid-November, we moved the comp back since the last time we were, under 268 from the end of November when we were 270. Dollar index going nowhere. But two other points. When something's expected, it doesn't mean there isn't a reaction. I fully expect, as Brian Selzman's been saying all day, that my bill for natural gas is going to be really big. But it doesn't mean when I actually open it up, I'm not going to blow a gasket. And as far as the microphone in the Fed, the 6.5% threshold that was discussed, if you read further into the statement, pretty much it sounds to me like they're throwing that guidance out the window. And I think it's normal they should. And how powerful is it, Mike? The Super Bowl's going to be Sunday. Yes, there's great, smart announcers holding microphones, but the real game's on the field.